Hey, what's up, guys? Thank you so much for tuning into this video. I'm gonna try to keep it as short and simple and easy to understand, digestible as I can. All right, the topic is infinite banking for actors, models, any type of creative individuals, anybody, essentially, really. What is infinite banking and how it's used, set up? You probably heard of um, infinite banking is the concept of becoming your own bank, and you can set this kind of situation up. Actually, it has nothing to do with the bank. You set these up through insurance policies, life insurance policies, and you've probably heard of companies like Ray Kroc, the founder of McDonald's. Trying to think, James Cash, Penny, J.C. Penny, um, the Rockefellers, uh, Walt Disney. Walt Disney, probably very famously, you probably heard of his story where he couldn't get a large enough bank loan to open the Walt Disney theme parks. So he borrowed from the cash value of his life insurance policy to fund the Disney theme parks that we have today. So many people probably heard a little bit about universal life and infinite banking, becoming your own bank. And I'm going to show you how these policies start, how to read them, look at the illustrations, and just kind of go over them real briefly here. And we can, if you want, feel free to circle back with me. My phone number is 424-346-0696 if you'd like to talk more about this after watching this video. Okay, so this is a policy I set up um, for Supermodel, right? She's age 22. Um, oh, hold on. I want to look at this one. Okay, we're gonna start out with Supermodel, age 22, non-smoker. She's doing a initial premium of $300 a month, and the initial out of the gate day one face amount is to over $292,000. What that means is, as this policy, if she was to sign the agreement, sign the contract, start this policy day one, if she got, God forbid, transitions to the heavens in a car accident the next day, her beneficiaries would receive $292,439 tax free, no taxes. That's exactly how much they would receive for starting this policy on day one. Okay, you can't get that through a 401k, you can't get that through an IRA, all the other retirement vehicles out there. You can only get this through a life insurance policy that protects you while you're saving for the future, a rainy day, retirement, college education for kids, whatever. Okay, so I'm going to show you real briefly. She's making payments of $300 a month, and usually they're long-term policies. They're designed for you to really be looking at taking money 20, 30 years down the line, at least 20 years down the line. Usually is the minimum you want to plan to create one that let it grow. Okay, so you're usually looking at least 10 to 20 years into the future when you open one of these policies. In fact, most policies will not allow you to take any type of money out of it in the first year. They figure if you're saving for retirement or whatever and you need to take money out in year number one, we've got that's a red flag. We've got a problem, Houston. Okay, so in any case, what this is how we read this. After 1 year, the 22-year-old will be 23, and she's paid $300 times 12 months is $3,600 in 1 year. This column over here is the interest rate, okay, that we're looking at. The illustration allows us, the insurance company is saying, okay, we feel comfortable with you illustrating it at 6.54%. This is actually a conservative number, but this is the maximum they will allow me to illustrate the policy at. The reason why it says non-guaranteed is because this is actually an indexed universal life plan. It's not just, it's so a universal life plan policy account, however you want to say it, is a type of life insurance. Now, indexed universal life means that it's it indexes the stock market. It mirrors how the stock market grows. And the stock market has performed at 10%, average 10% growth over the last 100 years. Okay, so we can allocate which crediting index we want to use. Don't let the financial jargon uh, throw you off. Okay, I'm gonna make this real simple. Don't worry, we can go over these concepts again if you're interested at all. You want to talk more about it, have questions. We can talk about these things more in greater depth. I just want to give this a fast preview for you. So knowing that this policy is an index universal life, what this means is non-guaranteed because after the first 12 months, it could go down to 5.5%, or it could go up to 9.8%. It's just depending upon the stock performance 12 months at a time. Okay. So every year that number is going to change, right? But the one thing that's great, one huge thing about IULs that's different from 401ks, any type of investment vehicle that's invested directly in the market, is that an IUL will never lose money in the market. You'll never lose money in the market, right? So you don't have to worry about, oh, if I put my money into an IUL, it's going to lose money. It's not going to happen. It's not going to happen. Your IUL is protected by a 0% floor. Some companies have a slightly higher percent floor. So, um, they're like having a savings account with an insurance company instead of with a bank, and they're liquid. They don't give you an ATM card. You can't just go pull up in an ATM and take money out. But if you need to take money out, you let the insurance company know and they'll direct deposit the money into your account, usually within 5 to 10 business days. Okay, so let's just look at the account growth for now. This person at $300 a month, basically, these are the three columns we're looking at. The account value, this is how much, when you make your monthly payments, some of it pays for the life insurance. Okay, pays for the life insurance that protects your beneficiaries, will pay off the mortgage to your house when you pass, so your spouse doesn't have to worry about it. Um, the other portion goes into what's called the cash savings. The cash savings is basically like we'll just bank account. It's the savings account, okay, the policy, and that savings account grows according to the interest rate. That is the how the interest rate yields every 12 months. Okay, so here's your account value. After 1 year, you've been putting in $3,600. Just over $2,700 is in your cash savings. The other portion paid for the insurance policy, right? Okay. Now the surrender value is actually the amount of cash savings you have access to, you could borrow from. Again, in the first year, you can't take any money out. Okay. But but moving on ahead of that, you can, and usually have access to about 80 to 90%, 95% of your money. Eventually, as the years goes by, you'll notice this account value and the surrender value, they'll become the same. The numbers will be the same. You'll have access to 100% of your money, right? So looking at this right here, what this is showing us that after 10 years, uh, you've put in $36,000. Your account has grown to you've gained about $1,200, 1247. Um, the account value has $37,247 in it. But this is the amount you have access to, about 36 and a half thousand. Okay, so you're pretty much kind of break even in the first 10 years, right? You're just putting money in, setting the foundation. Okay, now, and then the next 10 years, you're going to see the magic of compound interest grow for you, how it takes effect. So after 20 years, you're now 42. 22-year-old is now 42. Put in 72,000, and you've got access almost 120,000. So that's about almost a $50,000, like a $48,000, $49,000 difference. And keep in mind, this interest rate is conservative, right? So this could be a little higher, but basically you've made about, give or take, 50,000. Okay. After the next 10 years, you're now 52. You've put in 108,000, and you have over 285,000 available for you. So keep in mind, at any point in time, you could, I want to take out $60,000. You're 46, you want to take out $60,000. You want to open a nail salon. You want to open a restaurant, pay 3 months of rent, whatever, 6 months of rent. and start some sort of business that'll bring you some maybe passive income, depending on whether you work there or not, right? Or maybe you want to buy a house. The beauty of this insurance policy, the beauty of insurance policy, one of the reasons it's called infinite banking is because let's say you had this money sitting in a bank and you need to take out some money, or let's say you want to ask the bank for a loan, right? What's the loan going to ask you? The bank's going to ask you, well, how are you going to pay it back, right? They're going to ask you, how are you going to pay it back? They're going to run your credit score. They're going to see how much credit, how well your credit, how well you've managed your expenses, okay? Before they decide whether or not you're credit worthy, and then they might want to take collateral, which could be in the form of a mortgage on your house. They might want to put a lien on that. You know, they might want to, okay, we'll give you your house. Your house has to be used as collateral, right? So in an insurance policy like this, the insurance is the collateral. So again, this account value, the surrender value, I didn't talk about the net death benefit. The net death benefit is the face amount essentially plus the account value. So if I took $292,439 and added the account value to that, I would get this number, right? I would get the net death benefit. So every year, the net death benefit goes up and up and up. So you're earning more and more leverage, right? Now, if you were to take out $50,000, let's say this year you have let's just say 400,000, make it easy. You take out 50,000, create some nail shop or whatever. The fact that the insurance, no one's going to ask you, what are you using the money on? What's your credit score? How are you going to pay it back? No one's going to ask you any of that, right? Nothing. It's just going to, okay, you've got the money in your cash savings. As long as you have enough money here to cover the amount of the loan you want, then you're going to get it. The collateral is the death benefit, because at the end of the day, you take a loan from a bank and you mortgage the house for that loan. If you default on the loan, what's going to happen? They're going to take the house, right? If the insurance policy, yes, you're taking a loan against your cash savings, you're going to have to pay yourself back interest. You're paying yourself back interest, right? But at the end of the day, if you don't pay it back, first of all, it's a tax-free loan. And second of all, if you don't pay it back, that $50,000 or whatever you took will just come off the death benefit. So when you transition to the heavens, your beneficiaries will just get $50,000 less, minus the interest rate, the interest that you didn't pay yourself back. That's it. That's all it is, right? So the wonderful thing I have to point out about, let's say you did take 50,000 out, you got 108,000 right here at 41 years old, and you take $50,000 out. This is another key for why it's called infinite banking. Well, you're earning interest, right? But we would normally say, okay, so minus 50,000 here, let's just say it's 100,000. So you take 50,000 out and you're left with 50,000, right? And so you're expecting your interest to grow based on how much is 6.54% of 50,000. But no, this is the beautiful part. Your account still grows interest as if you had the full $100,000 in there. It doesn't even worry about the fact that you took out the 50,000 because it's assuming you're going to pay yourself back. So it doesn't matter. You're going to continue to earn interest on $100,000, even though you've only got $50,000 sitting in your cash savings. And that's a component to this infinite banking, because while you're using that 50,000 to make other money, you're still making interest rate money off of the money that you're using to, I don't know, buy property to rent out, or I don't know, buy a chain of gumball machines, whatever you're doing, right? So you're creating the capital that feeds your bank, and then you can tap into this bank whenever you want to, and however you need. You're in control. You own this bank, and that's how this works. Okay, so continuing on after 30 years, I showed you 108,000 contribution. and you have available 285. Let's go another 10 years. Another 10 years, you're now 62 years old. You've put in 144,000 and you have cash savings of 600, just over 600, $615,504. That's the cash savings available to you. Okay. Now I did this up to the age of 65, and then I assumed you're going to retire at 65. Maybe you don't want to contribute anymore to the policy. Excuse me. Excuse me. Um, so if we do that till the age of 65, what you'll see is after 20, what I did was I said, okay, let's take a salary for 25 years. So right at the age of 65, you've been contributing for 43 years, $3,600 a month, a year, excuse me. You've done a lifetime contribution of $154,800. And then if you wanted to take a salary every year for the next 25 years, the average life expectancy is under 85 in this country. But I did this until age 90, just to kind of cover some of you. Some of you guys got really good genes and you could go a long way. So basically, you could take a salary of $72,000, $72,036 for the next 25 years if you wanted to. And for a lifetime contribution of $154,800, you've just created potential income $1,800,900 in retirement income, more than 10 times what you've contributed to the life in the life of the policy. And keep in mind, again, this interest rate is conservative. So let's say you were to pass at age 90, you would still have 41,637 in cash value, and your family would get $334,076 to throw you a farewell party, and then cash out the beneficiaries. That's how this works. Okay, this is setting up your family for generational wealth. They imagine the next generation having this head start, almost 335,000. Okay, right, and all the time, all the while, you created a $1.8 million retirement income for yourself. By this point in time, you've probably paid off all your major expenses, your house, your kids' college education, whatever you've paid for, your biggest, largest expenses. You're just living off of, they've been paid off by, say, 65, more than likely. So to have $72,000 a year tax-free, that'd be a nice component of your retirement portfolio, right? And again, you don't have to wait till you're at retirement. You don't even have to take. I just generated this type of illustration. You don't have to take 72,000 a year. You can take 50,000. Excuse me. You can take 50,000. Maybe you're gonna, you know, like maybe you think you're gonna die sooner. Maybe you're taking 80,000. But I just did it. What I'm saying, the reason why I bring this up is you're not locked in to 72,000, whatever's on this. This is just an illustration, projection of how it could go. Right. Okay. So I'm going to very quickly show you what other numbers look like. So oftentimes most of the time, people that come to me, they're usually it takes a few years. You're a few years wiser than you are at 22. And so here's a person that comes to me at 31 years old. Now at 31, this person decided, I'm making good money. 1 out of 3 people is making over $100,000 a year, right? So we're 1 out of 3 people in this country makes over $100,000 a year. Oftentimes, people are advised to save between 12 and 20% of their income for the future retirement. You want to retire comfortably, okay? So if you're doing that at $100,000, 12% of your income is $12,000, which is $1,000 a month. If you're making $60,000 a year, 20% of your income is $12,000, which is $1,000 a month. So anybody that's in the $60,000 to $100,000 and beyond, I've got a lot of clients that do $1,000 a month. So I'm just going to use this as an example to show you how the growth might look. Okay, so here we go. After 10 years, put in 120,000, but you have 127,490 available. After 20 years, you put in 240,000, you have 412,970 available cash savings. Okay. Death benefits over $1 million. Okay. Started at 697,000, just over $697,000. Okay. After 30 years, this person that was 31 now 61. They put in 360,000. They have 975,280 in cash value. Okay. And then we're just going to take it to 65. 65. Cash value is basically 1.3 million. Okay. At this point, they just start taking income for the next 25 years. They stop contributing to the policy. They could take out $120,671 for the next 25 years if they want it. They could take out only 100. They could take out 80. They could take out, whatever they want. This is probably not the only thing you're going to use to save for retirement. But if you did that, basically off of a lifetime contribution of $408,000, you've created potentially just over $3 million in retirement income for yourself. It's huge off of 408,000 lifetime contribution. Okay. Real quickly, let's imagine, and I do have them, got some 22-year-olds. I got some younger people than that, and maybe it's families helping them, their parents, whatever, that are doing $1,000 a month. Okay, and I'm gonna show you what that looks like if you started that at 22. 22, you see the number, you've got 124,000 available at 32 years old, 10 years. After 20 years, you've got $408,071 available. After 30 years, $973,426. After 40 years, you're 62. You've put in 480,000. You've got over 2.1 million in cash savings at 62. At 65, you've put in a lifetime contribution of 516,000, and you're starting to take an income. Look at this salary I gave him for 25 years, taking out almost $250,000. Chances of, I mean, I don't know. I guess maybe in retirement age you need that kind of money. Some of you can travel the whole world if you haven't done it already by then. But basically, for a lifetime contribution of just over 500,000, 516,000, they've created potential retirement income of over 6.1 million off of 516,000. Last one I'm going to show you real quickly is, because believe it or not, I do have clients that, let's say she's 22 and they're making $100,000 a year, booking all types of campaigns. Yeah, a person like that, they might say, "Oh, I want to do 25,000 a year," right? So basically, that's 2,000, just over 2,000 a month. So I just did this one as 25,000 a year. The policy starts at over 2 million. After 10 years, they put in 250,000. It's at 262,307. After 20 years, they put in 500,000. I got 858, 407. After 30 years, they put in 750. They've got 2 million for almost 2,050,000. After 40 years, put in $1 million after 40 years. 4.4 million dollars cash value. That's over 4 times as much as they put in. And then at 65, over 5.5 million, right? So at that point, if they decide to take, an income for the next 25 years, they'd be taking out $547,568 per year. So off of, oh, I forgot. Oh, shoot, I forgot to stop the contribution. But that's all. Forgot to stop the contribution. Hold on, I'm gonna do that real quick. Hold on 1 second. I'm gonna pause the recording and I'm gonna fix that. Okay, so I'm back. I just went ahead and corrected it. So after putting in $25,000 a year for 43 years, at 65 years old, that 22-year-old, to put in a lifetime contribution of 1,075,000. They're taking an income for the next 20 years, 25 years, to go to 90 of over almost $520,000, just over $519,000 a year, creating a potential retirement income of almost $13 million a year. So you put in just over 1 million and you've taken out almost 13 million. And when they transition, go on to the heavens, the account would have 300,000 the cash value. The family would receive almost $2.4 million as the death benefit. To have a farewell party and give generational wealth, past generational wealth, to the beneficiaries. So that's the power of these types of policies. That's why people like Ray Kroc, James Cash Penney, uh, the Rockefellers. That's why Walt Disney. That's why they used universal life policies to create generational wealth, to create a nest egg, to be their own bank. You can do that too. You can do that too. So I hope you've enjoyed this presentation. Okay. If you have any questions, again, feel free to give me a call. My number again is 424-346-0696. And we can talk about how to design a policy around you and what you can comfortably afford. Okay. All right. That's it. Thank you guys so much. And I'm back. One addendum to this, I wanted to note the flexibility of the payments on these policies. All right, so you could start one at $300. A lot of times I have people start them at $200, 300, 150, 500, 400, whatever. They start them at the different amounts, but sometimes they have a cash flow issue some months or for 3 months, 6 months, whatever. Ideally, you would pay the initial premium that the policy was designed around. But it's important to know there is a flexibility. You can pay what's called a minimum no-lapse premium. This is enough to pay for the insurance and keep the policy active. And let me just show you, every policy is slightly different. So this person that's doing 300 a month could pay, if times got a little tough, they could pay monthly no-lapse premium $60.68. So if you can pay $100, you're good. If you can pay $75, you're good. $250, you're good. But if you have to pay the minimum of $60.68, okay, that's what time it is, right? So on the person that's paying $1,000 a month, this 31-year-old paying $1,000 a month, that no-lapse at minimum is designed a policy around $1,000. But if you have to pay, here's the minimum right here, $203.31. So anywhere between $203.31 and above, you can pay. So this amount right here is paying for the insurance. The other, anything excess over that is going into your cash savings, right? Okay. See, the 22-year-old paying $1,000 a month is probably going to be the same or roughly the same. Yeah, $206.96 per month. And then the person that's doing $2,000 a month could pay a minimum of $433.34. So if you're paying $2,000 a month and all of a sudden, oh, I had just had a bad month, you can pay $433.34. Okay. So that's a big difference between 2,000 and 500 bucks and less than 500 bucks. So you have a lot of room for flexibility of payments, and that's why a lot of people like universal life. So I wanted to point that out while I was thinking of it. Thought came to me right afterwards. And let me think if there's anything else. Um, no, you understand the minimums. That's it. All right. So, all right. Thanks again.